Hello and welcome to the DIY Investing YouTube channel. We are working through every company in S&P 500, and today is Carnival Corporation, ticker CCL. This company is in the hotels, restaurant, and leisure industry. Has a market cap of $15 billion and EV of $38 billion. So over the next few minutes, I'll discuss my thoughts on both valuation of this company and its business quality. We're working through every company in the S&P 500, and I am excited for this one. This is a cruise company. Carnival Corporation operates the cruise lines Carnival, Princess Cruises, Holland America, P&O Cruises, Seabourn, Costa Cruises, Ada, and P&O Cruises. Under these various brand names, they also have hotels, lodges, rail cars, motor coaches, and various things like that. So you see 87 ships, 223,000 berths. So this is the Carnival Corporation. Has a beta of 2, which is very, very high. Share turnover 812%. That's very, very high. What those numbers tell us is this company is likely more volatile than normal, which is useful information for us to have. So one thing that looks really interesting here is how this is set up in terms of return on invested capital. If you look at this chart and you only look at 2019 or 2002 to 2019, you'd say this is a very high quality company. It's incredibly stable. From year to year, there's very little change. Yes, you start out in 2002 at a 10% return on invested capital. Yes, you get down to 3% in 2013. But each year is a small change. 10%, 9.7, 9.9, 9.4, 9%. Very little change from year to year. Yes, it's declining over the course of that decade. You get down to 3% in 2013. But you never lose money in this period, and each incremental year is not that big of a difference. So even going into COVID, you're at 8, 9% return on invested capital. Those are decent numbers, not high numbers. This is certainly a highly capital-intensive industry, and what you see here is basically they earn low returns on capital during high oil prices, 2013, 2014, 2008, 2009, but they earn relatively good numbers during lower oil prices like this part of the decade, and then during this period when you had lower oil prices. But overall, from year to year, the stability is incredibly high, and a stable return on invested capital is a very, very good sign. Now, with that said, the last 2 years are terrible. And of course, these years correspond to COVID. In 2020 and 2021, for most of the world, you were just not allowed to operate a cruise company. And so you destroyed this business. You went from $20 billion in revenue in 2019 to $5.5 billion in 2020. Again, there were a couple months while you could still cruise, and then $1.9 billion in revenue in 2021. Absolutely massive losses. Massive losses. I mean, in 2020, you had $13 per share in losses. That wipes out 3 or 4 years of profitability. Then the $8.46 operates the rest of the decade. So you lost all your decades of profits in a 2-year period. Because of what happened here, you eliminated a dividend that had been paid for a while, and you turned into a very, very bad looking company. I mean, basically, when you look at this, there's almost nothing I can tell you of what it's going to be. Your 10-year median returns are all blown out of whack because you have all these great years. You're growing steadily. Look, each year is getting better and better for the most part. You have a slight dip in 2015 to 2014, but then the next year you're continuing to grow. And so all of this would tell one story, but then we have another story here with COVID. So the big question you have to have with this company is, will we ever again repeat having a period where you have another pandemic, where you shut down cruise lines? And the unfortunate thing is that because this has happened once, people can now believe that it's going to happen again. And you're going to have something like, if I had to guess, what happened with banks. In 2008, you had a massive banking crisis. And even still today, 14 years later, the banking industry hasn't recovered in the investor's mind that these companies are worth investing in. So you have a lot of people that just shun banks. They won't invest in banks, regardless of what things look like. And the same thing might be true with the cruise line industry, is because you had this 2-year period where the whole world said you can't operate your business, no matter what they recover to, even if 2 or 3 years later they're back to $20 billion in revenue, you're going to always have in the back of people's mind, well, what happens if the world shuts us down? And so this whole industry changed. This company became what would look good as a potential investment here to something that's just completely uninvestable based upon these. I mean, that's why like all these key statistics are meaningless, because you have losses here, you have negative revenue here, And that's all because it's taking these 2012 numbers up to 2021, and they just don't make any sense. So you have to really judge based upon what these numbers were going on. And so it's interesting, if we look and say, okay, let's say 2019 is what you get back to. You have 20 billion in revenue. So you have a price to sales ratio of less than 1 because you have 20 billion in revenue to 15 billion in market cap. Or you have a price to EV ratio of 2 because you have 38 billion. So this is a lot of debt. This is an incredibly leveraged company. But look, what were their earnings per share? $4.32. Let's see what their price is. So they're trading at 3 times peak earnings. That's cheap. As long as you get back to that, that's cheap. And as long as you never have another pandemic, it's cheap. This company's going to work out great. The problem is how do you predict that? I can't sit here and justifiably predict one way or another how that's going to go. So it makes it really, really hard to give a straightforward analysis because we just don't know what's going to happen. You can see that your revenues come back up a little bit, but we're really going to have to see. I mean, there's a possibility we're going into another recession right now, and so it's hard to tell. But like if you look at the historical piece, they were able to buy back shares in 2015, 2016, 2017, 2018, 2019. They're lowering the share count. And then basically your share count almost doubled in the course of a 2-year period because you had to dilute in order to keep operating. If we go to the balance sheet, I'm sure we're going to see massive growth in debt. You went from 9 billion in debt to 22 billion, 28 billion in debt. So you have this massive long-term debt growth. And so you had 9 billion in long-term debt against 38 billion in PP&E. So you were actually operating with a really nice equity position there. And then you had to destroy that because you had to leverage up with all this debt. So Carnival's doing okay because they had a lot of assets they could borrow against. But man, they're in trouble with the way that the business is set up. So you could dive into each of these pieces. But the problem is just on a quantitative basis, you can't really decide what to do about Carnival. These numbers, again, from 2002 to 2019, this looks like a strong, stable business. You do have growth. You're growing almost every year. You're profitable every year. But you need to answer the qualitative question with Carnival. Is the cruise industry ever going to recover to what it was? If you can answer yes to that, then that's a good sign. And will they ever be shut down wholesale again? And if you can answer affirmatively that they'll be secure in both of those, then you can consider buying a stock like this. But if you can't answer that both of those in a way that makes you comfortable, then you can't invest. And so it really comes down to a qualitative basis for assessing Carnival. I've never been attracted to the cruise industry because I don't like the capital intensity of this. And you see stuff like 3% return on invested capital. That's a really low number. Again, I like to see these double-digit numbers, and only in 2002 were you actually double-digit. So it's not like a super attractive industry to me inherently. The only thing that strikes my mind is that it's cheap. If you go on past earnings, you're 3 times that past earnings ratio. So it's like, well, can you ever get back to that? What are you going to have? And you're not going to hit that number because now you have double the share count. So you're actually at like 6 times earnings maybe when you adjust for share increases, and then you have more debt. So maybe you're at 10 times. So there's just so many complications here. So for me, I pass on Carnival. It's not an attractive business for me. But if you can assess those qualitative aspects, if you can understand whether we're likely to have another pandemic, if you can understand whether we're going to react in the next pandemic in the same way, then it might be something that's interesting. But for me, I avoid it. I hope this has been useful to you. Please hit that like button and subscribe so you can get more investing videos as I work through every company in the S&P 500. Your likes, your subscriptions help me to grow the show's audience, help me to continue to produce these videos to help you learn to be a better investor. Thank you for listening. Until next time, stop paying fees, start building wealth.